Welcome back. Now, with our theme, Thinking Beyond the Horizon at this year's Alpha Summit Global, we've been approaching the global financial system from a number of different angles. In this next session, we're going to be rethinking it all together through the lens of DeFi, or decentralized finance. Now, talking us through this is a real expert in the field, Professor Cam Harvey. He's a professor of finance at Duke University, partner and senior advisor of Research Affiliates LLC, and author of DeFi and the Future of Finance.
Thank you for inviting me to talk about DeFi, or decentralized finance, opportunities and risks. So a lot has changed over the last couple of years. And this is the CEO of the largest bank in the world, who made the claim that Bitcoin was a fraud, which is kind of a strange claim given that Bitcoin is just a computer program that nobody really controls. Indeed, he even told the employees at JP Morgan that they would be fired for trading Bitcoin. And the reason was that they were being stupid. So again, things have changed. So JP Morgan and most other large banks are all in to this space. Another thing happened last year that was really important in the crypto space. And that was the IPO of the most successful firm that deals in decentralized finance. And that was Coinbase. So Coinbase is a centralized exchange, and it deals in decentralized finance. And the IPO obviously was very successful. And I think that caught people's attention. Indeed, it caught the attention of many at Duke, given that Duke was an early investor in Coinbase. However, what I want to talk about today is not Bitcoin and not Coinbase. What I want to talk to you about is something that I think is under the radar. Yes, we hear a lot of talk about Bitcoin and Elon Musk tweeting about Dogecoin. But decentralized finance doesn't get the media exposure. And I think that what is there is something that is very promising. And I want to explain today why I think it's promising. However, I will also spend a lot of time talking about the risks in the space too. So this is a slide that I start my course out with. It's a word cloud, and it's interesting that the words, many of them you actually know in other contexts, like keeper or digest or node. But each one has a special meaning in decentralized finance. And part of the goal in terms of what I do in my teaching is to go through and my students get to understand to a much greater degree what each of these words actually means. So a good starting place is a definition. What is decentralized finance? So let me give you a simple example of a decentralized exchange. So a decentralized exchange is an algorithm. And sometimes we call these algorithms smart contracts. And let's say I've got asset A, and I want to use it to buy asset B. So what I can do is to send asset A to the decentralized exchange, and then it sends back to me asset B. The decentralized exchange is operational 24/7. It is completely transparent in that anybody can see the algorithm. I know what the liquidity is, and I know what the exchange rate is, A for B. So you interact with an algorithm. And that's an example of decentralized finance. And I don't think that it's far-fetched to to believe that in the future, many of our interactions will be with algorithms. And this is not just in the field of finance. So that's decentralized exchange. But decentralized finance is many other things. So for example, it could be savings. It could be lending. It could be just doing transactions. And I'll talk about in a little bit the idea of tokenization. The tokenization of both virtual and physical assets. So very interesting idea. So decentralization is basically fundamental to DeFi. And of course, before we actually look at any new technology, we need to figure out what problems does it solve. So I'm not impressed with a new technology that solves a problem that doesn't exist. That's not the case in decentralized finance. And let me go through some of the main problems that decentralized finance addresses. So inefficiency is the first one. And this is from my book, and it is a photo of one of the first wire transfers that was done. Western Union, 1873, for $300. And what I want to draw your attention to is the fee, 3% or $9. And it's remarkable how little has changed. We swipe a credit card and it's 3%. So my book was published in the fall, and a number of people contacted me and basically complained, oh, you're out of touch. You don't get it. It's way more expensive than you think to do a transfer with Western Union. So I actually went online and put in $300. What is it going to cost? And they give you 3 different options. So it could be credit card, it could be debit card, or bank account. So I chose debit card. And the fee, $47. So basically, not much has improved, and you can argue that things have got actually even more complicated. So this is an example of inefficiency. Another example is when you buy a stock. Seemingly you do that quickly, but to actually get ownership of that stock, rather than your broker owning it, that takes 2 days. In decentralized finance, the execution of a trade and the settlement of a trade are identical, happens at the same time. So number 2 is inefficiency is the first one, but the second one is limited access. So today we've got 1.7 billion people that are unbanked. And that is unacceptable. But what else is the number of people that are underbanked? And it's not well counted, but I expect it's much more than 1.7 billion. And what do I mean by underbanked? Let me give you an example. You're an entrepreneur. You've got a bank that you deal with. So you're banked. You've got a good idea. It's got a very favorable rate of return, over 20%. It needs to be financed, so your first stop is your bank. You pitch the idea to your banker, and the banker likes the idea. But the banker tells you, well, we would prefer to deal with one larger customer than 100 customers like you. But given that you are one of our clients and you have a bank account and a credit card, what we're going to do is to increase the credit limit on your credit card so you could take out the loan. So we all know what that rate is on a credit card loan. It's more than 20%. As a result, this really interesting and profitable project is never pursued. And let me tell you that that's exactly the type of project that we need to pursue as an economy to get us out of this lethargic 1 or 2% real GDP growth. And the reason that these projects are not pursued is basically, it's called a financial friction. And decentralized finance directly addresses that friction. So number 3 is opacity. So let me give an example of this. And I can't help but quote this letter that was written to the Treasury Secretary by Senator Warren. And a quote from this letter is that DeFi refers to a fast-growing and highly opaque corner of the cryptocurrency market. So when I saw this, I instantly realized that Senator Warren, or the person that wrote the letter for Senator Warren, is not really informed about what decentralized finance actually is. Decentralized finance is completely open source. The example I gave of a decentralized exchange, you can see the code, you can see the liquidity, you can see the balances, you can see the exchange rate. Everything is transparent. What is opaque is the current financial system. So when you go to a bank, you basically don't know how healthy that bank is. And you rely upon our institutions like the FDIC to reduce your risk. But our institutions have a dubious track record at best. And I'm not talking about going back to the 1930s. We can go back to the global financial crisis, where many people dealing with banks that went under. Okay, so opacity is a problem in our current system, and that problem is mitigated with decentralized finance. So number 4 is centralized control. And really what I mean here is that we've got a highly concentrated financial system. So the commercial banks are concentrated, which means they've got market power. In other countries, it's even worse in terms of the concentration. And what does that mean? It means that savings rates are lower than they should be. Borrowing rates are higher than they should be. Many people are excluded. And in decentralized finance, by definition, it's different. It's highly competitive. Everybody is a peer. There's no distinction between different actors in the space. Everybody is equal. Number 5 is the lack of interoperability. And what I mean by this is, suppose that you open an account, let's say on Robinhood, you want to do some trading, but you need to get money to Robinhood. So you need to transfer from your bank to Robinhood, and that could take 2 to 5 days. And then you're ready to trade. So that's lack of interoperability. In decentralized finance, it's dramatically different. You have a wallet, and you go to an exchange, you connect your wallet, and you're ready to go. Indeed, this is a feature of the so-called Web3 experience. So in Web3, there's no username or password. You connect your wallet, and you're ready to go. You're ready to buy, you're ready to receive funds, you're operational. And Web3 is not possible without decentralized finance. So let me talk about the risks, because of course in finance, we're balanced in terms of what we talk about. We'll talk about expected return, but we measure that with the degree of risk. And there are lots of risks. This is a new technology. And let me go through a few of these risks, and they are interesting in that there are new risks. And the first one is smart contract risk. So as I said, the smart contract is this algorithm that resides in a blockchain like Ethereum, and it allows us to do, let's say, decentralized exchange, or it allows us to do savings or lending. Okay, I already told you that this is completely open source. And I say the smart contract risk is a new attack vector. And what I mean by that is, let's say you're a hacker trying to get into Target, who was famously hacked in 2018. It's really hard to get in. So you could work for years trying to get in. And then once you're in, there could be millions of lines of code that you need to go through to figure out how to exploit. So with these smart contracts, they're completely open. So you could have hundreds of hackers looking at the code, trying to figure out how to exploit the code. And this is new. So again, this is a different type of risk. So there's many different ways to exploit or to find a problem in these smart contracts. It might be a simple problem, like a logic error, or it might be a more subtle economic exploit. So logic error, I'll give you an example of a simple one. And this happens, unfortunately, and it has to do with rounding. So it might be that the amount of liquidity in the contract is 13.9999, and there's a command to pay out 14. So 14 doesn't equal 13.9999. So the difference could be a fraction of a cent. It doesn't matter. The logic fails, and potentially the funds are locked in the smart contract. So an economic exploit is more subtle, and let me give you an example. So suppose the contract is using information from somewhere else. Maybe it's a price feed from an exchange. So suppose the exchange that's delivering the price feed is relatively illiquid. So an attacker could go to the illiquid exchange and do a buy or a sell order in size so that the price is manipulated. That price is brought into the smart contract, and that's the exploit. So you take advantage of a manipulated price. Okay, so that is just another issue here. So there's a third thing that is fascinating for me, and it's the flash attack. So let me go through that, because if there's one thing that I'd like you to leave with today is understanding what a flash loan is. So a flash loan is a loan that's completely uncollateralized. It has no duration. It has no counterparty risk and no interest rate. How is that possible? Well, it has to do with the way that a transaction works in decentralized finance. And I'll give you an example of how it works. So let's take a transaction with 5 steps. And step number 1 is to borrow some money. That's the flash loan. Step number 2, you use those funds to buy a token that you see on an exchange that seems relatively cheap. Step number 3 is to sell that token on another exchange where the price is relatively expensive. So you take the proceeds in step 4, pay off the flash loan, and then whatever profit you take in step 5. So the key thing with a transaction in the Ethereum blockchain is that every step needs to work. And if any step fails, then you revert to the state of the world before the transaction, so before the loan. So suppose you do step 1 and step 2, but when you go to sell that token, the price has fallen and you take a loss. That means you're unable to pay back the loan. That means the whole transaction fails. Okay, so that's why the counterparty risk is 0, the duration is 0, and the interest rate is 0 there. It's a very interesting idea and unique to decentralized finance. And indeed, I will show you an example of an exploit like this. And notice the very first step here is to borrow the equivalent of $200 million. Okay, think about that. So who can borrow $200 million with no collateral? Even the largest hedge funds in the world would have trouble doing that. But in this space, this could be a high school student who sees different prices on different exchanges, and she decides to do this transaction with a flash loan. This is interesting to me because this speaks to financial democracy. Remember I said that it doesn't matter who you are? So you don't need to be a hedge fund to actually do this. It could be anybody. Everybody is a peer. So there's many other issues here. This is a major exploit that happened on the Poly network, 611 million, at the time the largest exploit. And what's interesting about this one is the conversation with the exploiter. And let me go through some of that. So they're asking, well, why did you take $611 million? And the exploiter says, well, when spotting the bug, I had mixed feelings. Ask yourself what you would do facing with so much fortune. Should you ask the project team politely so that they can fix it? Anyone on the project team could be a traitor, given 1 billion is at stake, and it's rounding up, I guess, the 611 million. I can trust nobody. The only solution I can come up with is saving it in a trusted account while keeping myself anonymous and safe. This is an interesting one because the exploiter actually gave back all of the money and received a reward in terms of a bug bounty. And this is very common. The reward was actually minor compared to the 611 million, but some of these rewards could be up to $10 million. So you find the bug and then you report it. So again, there are many of these exploits. This is another one from March 2022, and this is a gaming platform that was exploited by actually North Koreans for 620 million. So what's the lesson here? The lesson here is that not all smart contracts are smart. Indeed, whenever I see the adjective smart applied to anything, whether it's a financial instrument or something else, I'm skeptical. Okay, what about governance risk? So these contracts, some of them are set in stone. So once it's deployed, then you can't do anything about it. It's there forever. Other contracts have the ability to change parameters. And there's a governance mechanism that controls that. So it is possible that the governance is actually exploited. And we often call the governance of a decentralized autonomous organization, or DAO. And often there's governance tokens. They give you the right to actually vote. So there have been governance attacks. And an interesting one that happened just recently in April is a protocol that was exploited for 182 million. And let me tell you a little bit as to how that happened. So essentially, some improvements were suggested. So they called them BIP 18 and 19 that looked actually like a way to support Ukraine in its war with Russia. So it looked okay until you started looking at the fine print, and it was really malicious in the fine print. So it wasn't getting any support. But at the last possible minute, an exploiter came in and did a flash loan and then was able to buy enough of the governance token to take control of the key parameters and effectively drain the 182 million. So everything was lost. So again, this is completely new field. And these are the sort of things that are happening right now because it's so young. And the more these things happen, the tighter the security actually gets, and there's improvements. But right now, it is very risky. Oracle risk. Well, I've actually already talked about an oracle, but I didn't call it an oracle. So anytime a contract uses information from outside its blockchain, that is called an oracle. So the example I gave was a smart contract that was using a price feed from another exchange. So you need an oracle to actually get that price feed. So one level of risk I talked about already, where you manipulate the price feed. Another obvious risk is, well, what happens if the oracle goes down? Well, if it goes down, then every single transaction that has a step that uses the oracle will fail. Remember, in this space, every step needs to work or you revert to where you began before the transaction. So again, this is a considerable risk in this space. Number 3 is scaling. And Ethereum right now uses a method of consensus called proof of work, the same consensus that Bitcoin actually uses. And that provides a constraint. And the constraint is speed. So Ethereum can do maybe 15 transactions per second, and Visa can do 65,000. So many people say, well, there's no way decentralized finance can compete at the scale of 65,000 transactions per second. Well, that's true today, but I think we need to look at what is on the horizon in this space. So the big thing is that Ethereum will be moving to a different consensus mechanism, and it's called proof of stake. And this greatly speeds up transactions, and indeed, it eliminates all of this redundant computing work that is done in Ethereum currently. So that will happen later this year or early in 2023. There's also the possibility of scaling. So while most of decentralized finance is based in Ethereum, there are many other blockchains that are Ethereum compatible that you can do smart contracting. And some of them already have systems whereby the number of transactions per second is greatly increased. So for example, you might have a smaller number of trusted validators rather than thousands in the Ethereum space, and that allows you to speed up transactions. So this already exists today. Ethereum is taking a different route where they will do what's known as horizontal scaling, and think of breaking their chain into 64 different kind of parallel chains. And there's a master chain connecting all of the 64. And this will allow them to greatly increase speed. So there's also something known as layer 2. So layer 2 is a way to do secure transactions, often small transactions that are aggregated off-chain, and then every so often they're written on-chain. And again, this is something that could deliver much more than 65,000 transactions per second. So I think that the scaling issue is a real problem today. And people complain about the transaction costs in using the Ethereum blockchain are very high today. And that is true, they are high. But all of these initiatives suggest that those costs will dramatically decrease in the future. So another risk is custodial risk. So who is going to hold your cryptocurrency? And this is an issue. So your custody is really what's known as a private key. So that's something that's secret that only you know. And that private key allows you to transfer your cryptocurrency. So like one issue is, what if you lose your private key? If you lose your private key, then you lose your cryptocurrency. And the private key is a long random number, 256 bits. So this is an interesting story. I'm not sure you saw from last year, but this is a German programmer, lives in San Francisco, had a number of private keys for Bitcoin in this case, and decided, well, I don't want to keep these on my computer because my computer can be hacked. I'll put them into a hardware wallet, and this is not connected to the internet, and it's really convenient because it's got a single password. And that's what the programmer did. However, he forgot the password. And the way the hardware wallets work, you get 10 tries on the password. If you fail on the 10th, then the hardware self-destructs. In this wallet is about $220 million of Bitcoin. The programmers tried 8 passwords. Each one failed. 2 more chances. So again, this is an issue. It's somewhat mitigated today because we do have custodial services that will basically guarantee the custody of your cryptocurrency. Environmental risk, and I hear this a lot. Bitcoin alone uses the amount of energy that Argentina uses. So that seems environmentally reckless. And like in a way, the blockchain that uses this proof of work, which is the very, very computationally intensive mechanism for consensus, it is like a strength and a weakness. The strength is the security that it guarantees. It's not possible with today's technology to exploit that. And it doesn't matter who you are, a hacker or a state actor, it is just really secure. But on the downside is the environmental risk. So what about that? And the way that I look at it is that Ethereum, which is the main technology for decentralized finance, is moving to proof of stake, which is environmentally friendly. See, the amount of electricity that's used for proof of stake is no different than the Visa or MasterCard network. So I think that this is mitigated for Ethereum. Indeed, there are Ethereum competitors that are operating today using the proof of stake. So they will switch. The issue, of course, is Bitcoin, and Bitcoin is not really used in decentralized finance. So in Bitcoin, you can only do transactions between people. So there's no way in Bitcoin to have a smart contract with the current version of Bitcoin. So regulatory risk, and let me talk about that a little bit, because obviously when the Securities Act was drafted in 1933, there was no cryptocurrency. So the regulators are struggling today as to what to do with this new space. And it is a real challenge for them. And I think they understand the challenge. So number one, if you want to eliminate all risk and be very harsh in the regulations, that means that the technology is going to go offshore. And you actually want to keep your best ideas within your country. So this technology is not a national technology, it is a global technology. So you can run it as easily out of New York as the Cayman Islands. So if you're too harsh, you kill innovation. If you're too lenient, then you have the Wild West and people are exploited. And indeed, that's the charge and the motivation for the Securities Act of 1933, given the number of people that were taken advantage of in the late 1920s. So what do? Well, you need to understand the technology, and it's difficult to understand. So you need to invest the time to actually figure it out. And then once you make that investment, you realize 6 months later that there's been substantial depreciation and there's new technologies that you need to learn about. So it's a constant learning exercise. And then on top of that, it's really hard to hire people that are skilled in this space because they have other opportunities. So let me conclude. And I've been in this business quite a while. And most of my time, other than the last 7 years, I focused on traditional finance. And in reflecting, I really think that over the last 100 years, we've been operating with a very similar model. So it's essentially the same central bank, the same commercial banks, maybe some name changes, some mergers, the same exchanges, the same insurance companies. Of course, there's digitization, but the infrastructure is essentially the same. And now there is some disruption going on with the current wave of fintech. But I argued that that current wave is fleeting, and I'm not alone. This is a speaker from my course who says, the current fintech, like Stripe and Plaid, is like putting lipstick on a pig. And what does he mean here? So number one, it's a good thing that fintech reduces transactions costs. So nobody disagrees with that. The issue here is that the current fintech uses the centralized financial architecture. And as a result, there's a limit as to how far those transactions costs can be reduced. With decentralized finance, that limit doesn't exist. And that's why I believe the current fintech will be fleeting. Let me also quote from a blockchain course at Columbia University. And this is Tim Roughgarden's course. And I would highly recommend this course. It's technical, it's for engineers. But if you want to learn more, this is a very good course. But his first lecture actually caught my attention. And let me just excerpt his first lecture, where he tells the students that future generations will be jealous of your opportunity to get in on the ground floor of this new area. That's pretty powerful. So something to think about, that there's an opportunity here. And these opportunities are rare in history. So from where I stand, and this is, I think, important to understand, this is not a renovation of our current financial system. It is a rebuild from the bottom up. And we are very early in, maybe 1% in, where we see the scaffolding of a new city. The other thing that's kind of surprising to me personally is my thinking about market exchange. I begin my book with the sentence, "We have come full circle." And what do I mean by that? What I mean is that when market exchange actually started thousands of years ago, it was decentralized. It was the barter system. And the barter system was really inefficient. And the barter system was disrupted when money was introduced. And market exchange became much more efficient. Decentralized finance redefines money. So we can tokenize any asset. So I could have in my wallet, I could have a token that's linked to the US dollar. I could have a token that's linked to gold. I could have a token linked to Apple stock. And when I go to pay for something, I choose. And maybe I'm getting some groceries and I decide to pay with some of my Apple stock. And maybe the grocer doesn't want that, they want something else, no problem. Seamlessly, the Apple stock is sent to a decentralized exchange and transferred into whatever the grocer wants. That is barter in a way more efficient way. So again, money is redefined in this space. And I thought, when I studied economics, I just could never imagine the return of barter. Yet today, it is real. So the last thing that I'll mention is that, and I hear this all the time, that some investors very nervous about this space. It's complex. There's exploits. There's some illegal activity. And they'll make the statement, we are not exposed to crypto. And that's a conscious decision. Our investment committee doesn't want anything to do with this. And I would challenge that sort of reasoning, because actually you might have negative exposure. So some of the companies in your portfolio of traditional finance have a bullseye painted on them. And if this progresses at the same speed that has progressed over the last few years, that could lead to a substantial degradation of the value of certain names in your portfolio. So think about it, even though you're not in, you're exposed in a negative way. So in the end, I've got lots of learning resources that are available, including my Coursera, 4 different DeFi courses that are available. And I'm really looking forward to questions. And Duke even has an NFT launch. So at this point, I will answer some questions.
Fascinating, thought-provoking presentation, and we certainly do have some questions. Professor Cam Harvey joining us live here. Good to see you.
Great to see you.
Thanks so much for that presentation. And I've just got to let you know, Professor Harvey, that during that presentation, we actually had a lot of comments coming in on the chat function that our viewers can contribute to, and also via the question app. And you and I now have just about 20 minutes to go through some of these questions. I was going to start with some of my own, but I'm actually going to turn to some of the audience questions first, because we need to address those. And I'll just let you know that broadly, some of the comments that we had, and I'm sure you expect this, and I'm sure you hear this a lot, is that some of the content of the presentation raises questions about fears around the stability of the current traditional banking system. And also comments about issues regarding arbitrage and speculation, of course, in the DeFi space and the crypto space. I know you will come up against these kind of ideas a lot. So I want to let you know that that's what the audience are thinking about and talking about. And we've had some questions off the back of this. And of course, since you recorded that presentation, a lot has happened in the crypto space, especially in the last week. And we were going to start by talking about the Terra Luna ecosystem. We actually got a question from the audience on this. So I'll turn to this one now. This person asks, given the recent blow-up of the Terra Luna ecosystem and the UST stablecoin, how do we ever get to a point where we can completely trust a decentralized entity as the foundation for a monetary system?
So this is a very interesting question. And as I said, this is a complex space. So when you talk about crypto, there's so many different categories. And then even when you focus on stablecoins as a category, there's a diversity of different types of stablecoins. So there are 2 basic types. One is a collateralized stablecoin, and the other is an uncollateralized stablecoin or an algorithmic stablecoin. So within the collateralized stablecoin, you've got centralized coins like Circle's USDC or Tether. And then you've also got crypto collateralized stablecoins, and these are over collateralized because of the volatility of crypto, like DAI, DAI, and FEI, FEI. So when you talk about an uncollateralized asset, We know not from crypto, but from regular experience in finance that when you're under collateralized, you are at risk for a bank run. And if you're not collateralized at all, then you're at risk for the so-called death spiral. And that's exactly what happened to this algorithmic stablecoin. And again, we've seen this how many times in regular finance? You've got a convertible bond, convertible to equity. People start to convert. They get the equity. They sell the equity. And the price of the equity goes down, which means the other people converting get more equity. And you go into this death spiral. So this is nothing special to the crypto space. And when you've got something that's uncollateralized, you run a great risk. Now, it's interesting that the decentralized stable coins like DAI and FEI, they weren't affected by this. And USDC, run by Circle, wasn't affected, but Tether was. It broke its peg. And the reason is that Tether is so opaque. People don't really know if there is collateral. So there's a risk that is under collateralized. So again, this is, I think people also don't focus on the benefits of these stable coins. And effectively, it allows us to move money all over the world very quickly at very low fees and increases efficiency. So yes, this particular algorithmic stablecoin failed, but I think that you need to look at the more prominent stablecoins, and they were essentially untouched by this.
And it's an argument we hear from the crypto community a lot, just basically hold, stay long. This is a natural part of the cycle, as you say, of innovation and creativity. But of course, it does knock what little trust there might be in the system. A separate question that we had, I'm glad this one came through as well, because somebody else, there was a bit of chat about this. When you were talking, Professor, about the credit card system, for example. Somebody's asked this. The mechanism to facilitate a credit card transaction is complex. It touches multiple entities, yet it's completed in a fraction of a second with mature fraud prevention built in. Can you describe a decentralized credit card model and explain why you believe it is better than that current system we've already got?
So again, the reason that we pay 3% is the cost of the infrastructure and the cost of the fraud. Yeah, I just went through last week. My credit card got compromised, and thousands of dollars were rung up on my credit card. And effectively, the card company is going to make it whole. So within this space, it doesn't use the centralized banking system, and there's a high degree of security. So you control your private keys, and that's it. So it's linked to your identity. So I think that in the future, payments will become much more efficient. So it's not just credit card or debit card payments, but wire transfers. This is the original vision, actually, of Satoshi Nakamoto, that his vision or her vision was that this would be a transformation of the payments mechanism that right now is very inefficient. So it's slow. As I mentioned, to do a wire transfer, it's 2 to 5 days. So credit cards, of course, are faster, but they come at a cost. And 300 basis points of cost, that's unacceptable. And many people in the world have no access to a credit card. And indeed, the fees for credit cards were used to 3% in the US, but in other areas of the world, they're much higher. So 300 basis points of friction, that's unacceptable, and that will be replaced. So you mentioned that, what's going to happen to the banking system, because that's an important part of what they do. Well, many of the things that the banking system does today will be disrupted. And we're seeing this already with Fintech, where you get lower cost for your financial services. But decentralized finance goes even further. And we will have new systems. And I'm not of the opinion, so just to be very clear, I'm not one of these people that says everything in the future will be decentralized. So we go from 100% centralization to 100% decentralization. No, this is not a binary sort of outcome. There's a continuum. There's certain things that are more efficiently done in a centralized way, and certain things that are more efficiently done in a decentralized way. And we'll find that point where it's optimal. Will the banks exist in the future? I actually think yes, but they will be doing different things. There'll be different models that are pursued. So we will have this balance of centralization and decentralization. Unfortunately, today or 5 years ago, it's almost all centralized. And with that centralization, there's a lot of inefficiency.
And picking up off that point, we've been hearing as a theme throughout the summit from various speakers that we all need to engage in conversation that makes us uncomfortable, or go and find news, or speak to people that we actively dislike what they're saying because it challenges our established ways of thinking. So I can understand that some of the comments that you made in your presentation are uncomfortable for a lot of people in the traditional financial services industry to hear. But I want to pose you that question. When it comes to decentralization, you say that these two models can essentially coexist. We'll find a happy medium in the future. The banks will still exist. They'll just find a different way of living. But to what extent at the moment does DeFi rely on this antagonistic, sort of almost renegade, rebellious kind of feeling in order to just exist, to get people's attention?
Well, it is kind of a shocking innovation where major financial ideas, such as decentralized exchange, essentially come from computer scientists. So we're used to relying upon our economists to come up with innovation, but we're seeing basically this crossover, this synergy with computer science, and I think the payoff already has been very substantial. So we've got new ideas out there, and look, what is the goal here? The goal is not necessarily to maximize the value of the banks. The goal is to set our economy on a course where we can reduce financial frictions and increase economic growth. We are in a situation where we've got a very large amount of debt. And there are basically three ways to deal with national debt. And one way is to raise taxes. Nobody wants that. Number two is to inflate, and nobody wants that. Number three is to grow. And my academic research shows there's a direct relation between reducing financial frictions and growth. We need to get out of this mode of 2% or 1% or 3% real GDP growth. That is the promise of decentralized finance, that we can reduce the frictions, we can level the playing field. And with this financial democracy, put our economy, and not just our economy, but the world economy, on a different growth vector, where if you've got a good idea and people agree it's a good idea, it will be financed. And these projects we need, and right now, many great ideas are not being financed and not being realized. We don't get the investment, we don't get the employment, and we don't get the growth. So I think you need to look at this in the big picture way. And yes, of course, any new idea creates some discomfort, and it will be disruptive. So some people will have to move to different jobs. And I think that's also good for the economy.
We have had people very much engaging with the technical elements you mentioned. We've had two questions through on flash loans, which I'm just going to combine into one. This person asks, what is the size limit to a flash loan? How quickly does it take to execute one? And the follow-up question, and the flash loan process does seem to eliminate risk. If the sale results in loss, then the transaction doesn't go through. Is that true?
Yeah, so this is great. So in my presentation, I showed a flash loan and it was like $200 million. But there have been larger ones. So the largest one I've seen is $4 billion. In terms of the time it takes, about 20 seconds. So that's about the time between Ethereum blocks. So it's very quick. And, and yes, it only goes through if this is like an arbitrage play, like I mentioned in the presentation, if it's successful. But that doesn't mean that there isn't any risk. And I didn't have time on my presentation to mention this, that if the transaction doesn't go through, then you still pay the transaction fee. And you know what that is. So that's what you're putting up. There's a fee for doing the transaction. And if it doesn't go through, then you'll lose that. And currently, the transaction fees are large. And this is because of the lack of scalability right now in the Ethereum ecosystem. That will change. And then as that changes, the transactions costs come down very dramatically, the fees come down very dramatically, and it makes this arbitrage much tighter. And people say, well, we've got a system today where we've got these very concentrated exchanges like NASDAQ and NYSE, lots of liquidity. But in the decentralized finance space, you've got hundreds of exchanges that many of them are illiquid. But with this arbitrage mechanism, with flash loans, it effectively networks all of these exchanges together. And it's so easy to go from one exchange to another. They're interoperable. They're like Lego blocks. This whole decentralized finance fits together. You can't do this in centralized finance. So the interoperability is really important. So flash loans, as you can tell in my presentation, I'm very excited about. It is financial democracy.
And financial democracy is where I wanted to take this next, because the idea of the underbanked is an issue we opened this summit with our speaker Tyrone Ross, and we've got a question in from the audience talking about the issue of financial illiteracy amongst the underbanked and the unbanked. And this person asks, how will DeFi solve this barrier? Which I do think is interesting because there is some complex terminology that comes necessarily with DeFi.
So right now, as I mentioned, we're really early. So we're 1% in, maybe. And yes, it is true that the mechanisms are pretty clunky right now. And indeed, I remember using the internet when it was clunky in 1981. So I think that we're getting to the point where the interface will become much easier. So you have a mobile phone, then you're banked. And that's it. Your mobile phone is your bank. That's your vault. You are now connected to the internet through Web3, and you can move money and receive money. And you don't need a formal commercial bank. Indeed, we see this in many emerging markets where, for example, in Venezuela, you've got hyperinflation. If you're rich, well, you've got a bank account in the US and US dollar deposit, you're hedged against the inflation in your home country. Usually, everybody else was hit really hard by that inflation. But now you've got a mobile phone, and your mobile phone has got some US dollar coin, a token. So effectively, the rich have got their account in Miami, and those with a mobile phone have got their own US dollars on their phone. And you've disintermediated the central bank and effectively the government in that country. And it's not just Venezuela. You see the same thing happening in Turkey with their 70% inflation. So I think that this is very powerful, that your bank is your mobile phone or your laptop computer. And this technology allows everybody to be banked.
We do have to wrap up shortly, Cam. I want to finish on this final question because it brings us back to what's currently happening in the markets at the moment. Quite simply, this person asks, how do you recommend valuing a cryptocurrency?
So again, this is such a broad space. So there's so many different types of cryptocurrencies. So it's easy for me to value something like USDC, which is linked to the US dollar. It's easy for me to value a token that's backed by gold because it's the price of gold. Or it's easy for me to value a token that's linked to a stock or a bond. What's more difficult is to look at tokens that are linked to a particular protocol. And many of these protocols, you do have some comparables. So for example, you've got a token that's used to pay for, let's say, computing time or data storage. Well, we've got direct comparables where we can go to see the prices on AWS or other competing services like that. So that is straightforward. What is difficult is to look at the so-called layer ones like Bitcoin. And Bitcoin is a transactional token mainly used for speculation. And there's many different models for valuing Bitcoin. And to me, they're all unsatisfactory. I think that there is a value to a network effect where the crypto actually delivers something that you couldn't do before. There's a value to that. But it's really hard to figure out what that value is. We can't plug in to our traditional models. And no surprise, these cryptos are very volatile. So why are they volatile? Well, they're difficult to value. There's a lot of uncertainty in terms of the valuation. So it is a question that deserves more than a couple of minutes. My Coursera goes into this in much more detail. And the key is you can't just say, well, how do you value crypto? Because the space is so diverse. There's so many different types. Some are easy to value, some are more challenging to value. But the fact is that there is great promise, and it's hard to argue that the value is zero.
A brilliant way to end. Yes, do go read Professor Cam Harvey's books if you would like more information. Professor, really appreciate your time today. Unfortunately, we do have to wrap up there.
Okay, well, thank you.
Thank you.